My name is Jack Keeler. I'm account executive at Flagstar Bank. And one of the top questions that I receive almost on a daily basis is, Jack, do you have the 2-1 buy down program? Well, my question actually back to that is the 2-1 buy down program the best program for your customer? So first, let's look at what is a 2-1 buy down. Quite simply, it is just that the seller gives a credit for the first 2 years of the loan towards a lower interest rate for the borrower. So what does that look like? Now, let's say for an example, your forever 30-year fixed rate is a 6.625 rate. What the seller's going to do is they're going to pay the portion of that payment to give you a 4.625 rate for that first year, which is the 2, and then you're going to get a 5.625 rate the second year, which is the 1, and they're just making up for the difference in that payment based on those rates. So regardless of what the seller gives in contributions, their forever rate is 6.625 in this example. Now, what I want to present to you is what happens if we take that same 2%, and it equates to about a 2% in seller credits to get that 2-1 buy down program. But what I propose is we take that same 2% in seller credits, but rather let's apply it to a permanent buy down. Now, in this particular case, in this particular scenario, if you were to take that 2% in seller credits, that would equate to about 2.28% in permanent discount points. Now, with a 2.28 discount points on this, it would give you a permanent rate of about 5.575%. So a 2-1 buy down at 6.625 or a permanent buy down at 5.575. Either way, the seller is paying the exact same amount in discount points. Now, the question would be, what is the best for the customer? So if you're going with a 2-1 buy down, some of the best reasons to do it is, say the bar is moving in the next 2 to 3 years. That's a great idea for that 2-1 buy down. Let's also say that the bar will be receiving a raise in the future and they'll be able to afford a higher payment on that third year. Certainly a great way to think about it. Or if they really plan on refinancing within the next 3 years, it's a good deal to do that 2-1 buy down. But here's the point, and I would think you should be crystal clear with your clients on when and when it may not, to make sure they have the proper information to make a decision. The times that the things they're going to want to consider is in 3 years or 2 years when they go to refinance. Life changes, jobs changes, finance changes, and there is potential that they may not qualify for a loan in 2 to 3 years. And in that instance, the rate's going to go up from that 4.625 to the 5.625 to the 6.625, and they can't do anything about it in a refinance and put them in a worse position. The second thing that could possibly happen is it loses purchasing power. Because you're competing with a 6.625, you can get a lower payment on a permanent buy down, and they can qualify for more of a home right now. And lastly, it is a guaranteed life of loan, no risk. So when you tell them that, yes, you may be better off for the first 2 years, what's going to happen in 2 more years? You can give them a permanent guaranteed rate now. So whatever you do, give your borrowers a choice and make sure you educate them.